and it is called The Big Beautiful Build. And y'all, it is over 1,000 pages long, and it includes a wealth of information. And so I did go through it. I took a look at it. I jotted down some notes of things that I thought was, for the most part, important, things that is staying that was previously implemented in the tax bill, or things that are already in the tax bill, some things that's going to be new in the tax bill. So it's just a lot. Let's kind of go through it and see how taxpayers in general are going to be affected. So one of the first things that I did capture is that there is a proposed increase in standard deduction. And so there's a proposed increase as well as a proposed temporary enhancement. And so what the House wants to do is to make permanent the standard deduction rates of a single person of $15,000 and for married people of $30,000. But there will be a temporary enhancement between the years of 2025 to 2028, where there will be an additional amounts that will be included in there, added to it. Let's just say that for a single person, the additional amount will be $1,000, for head of household $1,500, and for married couples $2,000. The permanent extension, or the permanent standard deduction, would be put in place in 2027. So the temporary enhancement would be for years 2025 to 2028, which is tax filing years 2026 to 2029. And then after then, it will be the permanent standard deduction of the $15,000. Another thing that I saw is that the House wants to permanently take out personal exemptions. So prior to the TCJA laws back that was established in 2018, there were personal exemptions that was given for individuals. And so those exemptions have not been in existence due to the TCJA laws. And so it's being proposed that they are completely eliminated, that it's going to set to run out. Another interesting thing that I saw was the child tax credit. It is being proposed that the child tax credit would permanently be $2,000, and that there will be a temporary increase between the years of 2025 to 2028, to where that amount would increase to $2,500. Another thing that I found interesting, I didn't mention this before when I was talking about the standard deduction, is that when you apply for these credits, it is only for those that have Social Security numbers. If you're a single person, you have to have a Social Security number, or if you're married filing jointly, your spouse has to have a Social Security number as well too. No ITIN numbers, which is an identification taxpayer number that is issued by the IRS. They only want your Social Security numbers as well as your dependents to have the Social Security number. The good thing about this child tax credit that they're proposing is that it will be refundable up to $1,400. And so they want to permanently put it in place starting in 2029 of $2,000, but until then, meaning between the years of 2025 and 2028, there will be a temporary enhancement of $2,500 per child for the child tax credit. Another thing I found interesting was the tax-free tips. So there would be no tax on tips. Basically, tips will be fully deductible from your taxable income, tax-free for workers, and to qualify for the role must have been a traditionally customarily role or job that received tips prior to 2025. And so basically that's wait staff, bartenders, that's in beauty services, hairstylists, nail techs, those type of service type of industries. So basically what they're saying is that we can't start converting all types of industry over to receiving tips so they can be deductible, non-taxable for the future. And you can deduct these tips even if you do not itemize. So you don't have to itemize in order to deduct them. They would also qualify for employer tax credit. So that would be an extremely good thing. In order for the tips to be recognized as not taxable, the employers must separate out the tips on a W-2 form. So as employers are issuing W-2 forms, then it has to be separated out what amount is their W-2 wages and what amount is considered to be tips that they receive for their services. Again, those individuals must have a Social Security number, and their spouse must have a Social Security number as well too. And so when we speak of the tips, the proposal says that the tip has to be voluntary. So there cannot be where if you're a hairstylist that there is a mandatory fee of, let's say, $10 or a certain percentage of the service that's going to be considered a fee. No, the tip does have to be voluntary. You can't make anyone pay it or include in your services. It can be reclassified from income. So if you're receiving income and you're receiving tips in addition to that, the tips has to be considered tips, and your actual W-2 income has to be considered W-2 income. That can't be a way that you're classifying your W-2 income over to be considered as tips. And this would go into effect as early as 2025. So this is what's being discussed in the proposal. Another thing very similar to that is no tax on overtime. So usually if you're working overtime, you are making 1.5 times your regular pay. Well, what they're saying is that when you have overtime, that it is now going to be deductible from your taxable income. Now, in order for you to be eligible, you have to be considered what is called non-high wage worker. And so for those that are making over $150,000 in income, or they're considered to be highly compensated, then they do not qualify to have their overtime deducted from their taxable income. Again, the requirement is Social Security number for yourself and your spouse. The amount that you receive in overtime does have to be separated out and reported separately from the W-2 income. So another thing that I found interesting as well too is that there's additional deductions for seniors. So that is for our seniors that are 65 and older. There is going to be a temporary enhancement from the year of 2025 to 2028, where they will receive an additional $4,000 on top of their standard deduction. But there will be a phase out on that amount. So for any senior over 65, if they're single and they're making over $75,000, then their additional deduction will be reduced by 4%. Or if you are married and you both generate jointly $150,000 or more, then it's reduced by 4% as well. And rules, Social Security number for yourself and your spouse, and you can either take the standard deduction or you can itemize your deduction. There is no guidance so far on which one you have to do. That's definitely a blessing and a privilege for our seniors here that's included in this proposal. Another thing is car loan interest. So they're proposing that car loan interest is deductible up to $10,000 per year, and you can deduct it even if you don't itemize, which is interesting because now when it comes to your home mortgage interest, you can only deduct it as an itemized deduction. So that's a really good thing for the car loan interest that they are proposing. So that would include interest for cars, motorcycles, minivans, SUVs, RVs, ATVs. It would include all of that. It would be for loans that you have for the actual vehicle themselves. If you have a lease, it would not account for amounts that you pay for leases, or if you purchase a vehicle from what's considered to be a related party by the IRS, it would not include those purchases if you happen to end up paying interest on it. Also does not include amounts that you receive for a personal cash loan. So if you receive a personal cash loan and you buy a vehicle with it, the interest that you pay on that loan would not be deductible under this part of the proposed bill. And this will come into effect as of 2025. Another thing is tuition. Let's talk about the tuition here. So elementary, secondary, and homeschool expenses may be treated to qualify as higher education expenses for 529 accounts. So tuition for kindergarten through 12th grade, homeschool costs, if you're paying for tutors, if you're taking a standardized test. So basically what they're saying is expenses that you could use these 529 accounts to pay for tuition for those in kindergarten to 12th grade, for homeschooling, for tutoring, paying for standardized tests. So if you are paying for an AP class and you have an AP test, or you have a dependent that's doing so, as well as the ACT test or the SAT test, any type of dual enrollment fees, they are proposing that those funds can be used from the 529 account. The only qualifications that they have is that the entity that is providing the service, or who you're going through to get these services done, is that they're one state licensed, or they have to be a former teacher, or they have to be a subject matter expert in whatever it is that you are hiring them for that service of. So I thought that was pretty good when it comes to paying for those education costs. Also, charitable contributions. So this bill is proposing that you can deduct, as a single person, $150 for charitable contributions, or if you're married, you can deduct $300 for charitable contributions, even if you don't itemize, because now we know that you have to itemize in order to take take advantage of those contributions. Well, now you don't have to itemize to get this benefit, but it is limited to $150 per single person or $300 per married person. Next, we have some health and medical provisions that they've spoken about or that they have included in this bill here. So basically, certain physical activity, fitness, and exercise equipment or activity may be considered paid for as medical care. So I found that to be very interesting. Another thing is that spouses would be able to contribute to the same HSA. So currently, as of now, when you have an HSA, it's usually one spouse can have an HSA. It can be cover the entire family, and then if the spouse decides that they want one as well too, then they can create an HSA. It can be for them individually or it can be for the family, but they have to have their separate ones now. And what this is proposing, that spouses can have one HSA and they can both contribute to it. And also they're proposing that there's an increase in health savings account contributions. So let's move on to the business side of some of the provisions that is in this proposed U.S. bill. So one of the first thing is the QBI deduction, the Section 199A deduction. And so that is basically the 20% pass-through business deduction that came into play with the TCJA laws and have been in effect since 2018. So it is set to expire in 2025, this year. What they're proposing is that they make it permanent, and they also want to increase the deduction from 20% to 23%. They also want to add that eligible income from business development expenses would be added to the QBI as well too, because in the past that was not included, and it will be effective as of January 1 of 2026 if this passed. So this is a good one here. Let's talk about depreciation. So in this bill, they're proposing to extend bonus depreciation back to 100%. So we saw previously, a couple years ago, or let's just say a few years ago, depreciation was at 100%, and then there started to be a phase out. It went down to 80%, to 60%, to 40%. Now the proposal is that it is extended back up to 100%. So that means that businesses can immediately deduct the 100% of the cost of their qualifying machinery or asset as long as they put it into service before December the 31st of 2030. There will be no phase out. It would stay exactly the same, which is at the 100% bonus depreciation. Now, there will be a special provision for assets that were purchased after January the 19th of 2025. So if an asset was purchased after them, as long as it is put into service by 2030, then it will qualify for the 100% bonus depreciation. Now, any asset that would normally qualify for bonus depreciation, if it is purchased before January the 19th, then it is treated as a pre-2025 type of purchase. So that bonus depreciation of 100% would not come into play for that. Pretty much the goal is to boost the cash flow for businesses that are investing in equipment and manufacturing and transportation type of industry, and that will be effective as of 2025. Next, we have the R&D credit, which is the research and development credit. What they are proposing is in 2025, businesses can fully deduct their domestic R&D expenditures, pretty much assuming that they are US-based research, in the year that it's incurred. And so that would include software costs as well too. And something that would not qualify for it would be the land acquisition and improvement. So you can purchase land and do improvements on it for it to qualify as research and development costs. But when it comes to foreign research and development, they are proposing that it is amortized over 15 years. So that's how the foreign R&D cost is going to be handled, that they're proposing is going to be handled. And then last up, we have opportunity zones. So if you remember, opportunity zones were first put in place with the TCJA laws, and it was a way to get investors to invest in areas that needed some tender loving care. And these were areas that was designated as opportunity zones. And so what they want to do is that they want to expand the areas and update what qualifies as low income communities. And so so what they are proposing is that they adjust the income threshold in those areas from 70% to 80% of what that area median income is. And so once they get to that amount, they can now determine what those rural areas are going to be considered low income, which means they'll be expanding what those opportunity zones are. They're proposing to have a new rural focus. So basically, the bill will require at least 33% of new opportunity zones to be in rural areas. And the timeline for this, it's supposed to expire in 2025, but they would extend it to 2033. So as long as it was purchased prior to 2026, but put into service by 2033, they would have up until that time for it to qualify as an opportunity zone. So the tax break for long-term rural investments would increase. So it would increase from 30% to 10% for investments as long as they are held for more than 5 years. And I found this interesting. So when you do invest in an opportunity zone now under these new rules, there's going to be tighter reporting requirements. And so they're going to require detailed annual reports from the fund about the investment itself, about job creation, and about the census tract impacts. And so the impact that it's actually having on the community itself, because when we say opportunity zones, the goal is to have investors to come in to make a difference and make that area better. And so these reports are going to show exactly what each of those opportunity funds are doing in order to improve that area. And this would go into effect for 2025 starting in 2026, because as we spoke before, the current opportunity zone laws are going to expire at the end of 2025. There's a lot that is taking place with the big beautiful bill, and so you want to stay up to date, because all of this information is going to be critical when it comes to your tax planning for the future. Whether you are an individual that has a side business, whether you own real estate, whether you have a corporation, everyone is going to be affected by this new bill. So you want to stay up to date on it. Make sure that you like this video and you subscribe, because I'll be putting out more videos as we get more information, as things change, as things are passed, as things come into effect. Make sure to keep you guys updated on. So make sure that you are following. And if there are any other topics that you are interested in knowing about, leave them in the comments below. I would love to hear from you. I'll see you in the next video. Bye.